Hey there, fellow deep divers. Ready to plunge headfirst into the world of ESG?
Always up for a deep dive, especially one this impactful.
It's not just about warm fuzzies anymore, is it? ESG can really impact a company's bottom line. And, you know, let's be real, your portfolio too.
Absolutely. And what's so fascinating is how intertwined ESG is with the nuts and bolts of corporate ownership and
You
governance.
can't have one without the other, right?
Precisely. You need to understand both to get the full picture.
I was doing some reading on global ownership structures, and wow, they really vary all over the map.
It's a global tapestry of ownership models.
Definitely not one size fits all, huh?
Not at all. In fact, concentrated ownership is way more common than dispersed ownership globally.
Interesting. So are we talking like family-controlled firms?
Exactly. Those are big in Latin America.
Right.
And then you have state-owned enterprises in certain sectors. Oh, and don't forget about those powerful company groups we see in places like India and Russia.
It's like a global corporate puzzle.
It really is. Each structure adds a unique flavor to the mix.
Okay, so for those of us who might not be fluent in corporate structures 101, can we break it down?
Sure. Let's start with dispersed versus concentrated ownership.
What's the big deal and why should we care?
All right, picture this. Dispersed ownership is like a potluck dinner.
Okay, I'm listening.
Everyone brings a dish, but no one's really in charge of the menu. It's all spread out.
Okay, got it.
Now, concentrated ownership, that's like having a master chef running the kitchen. They call all the shots.
Ah, I see. More control at the top.
Exactly. Now, both setups have their pitfalls.
Yeah.
Dispersed ownership, you might run into what we call the principal-agent problem.
Okay, so that's where things get tricky.
Yeah. Think of it like this. The shareholders, those bringing dishes to the potluck, ultimately want a delicious meal. Right. In the corporate world, that means maximizing value.
Makes sense.
But the managers, the ones actually cooking the food, might be tempted to sneak in some extra dessert for themselves.
Even if it means a less satisfying meal for everyone else.
Precisely. So there's this potential misalignment of interests.
So there's a disconnect between who owns the company and who's running the show.
Exactly.
And without someone keeping an eye on things, it can go off the rails.
You got it. But even with our master chef in charge, you're not completely out of the woods.
Oh, really?
Yep. Concentrated ownership can lead to what's called principal conflicts.
Okay, this is getting interesting. Tell me more.
So imagine our master chef decides to only make dishes they personally like.
Even if the other diners at the table, let's say they're allergic to seafood or just hate spicy food.
Exactly. It's all about power dynamics in this case.
The controlling shareholder might put their own interests first, even if it means the minority shareholders get a raw deal.
You hit the nail on the head.
So it's not always as straightforward as just, dispersed versus concentrated. There are other layers to this.
Right. Think of those complex recipes with a bunch of sub-recipes. Horizontal and vertical ownership arrangements. They can create these tangled webs of control.
Ooh, tangled webs.
Yeah. It gets complicated. One company might hold shares in another in the same industry, creating a whole different flavor profile. Or you have a parent company controlling various subsidiaries in a supply chain, sort of like a culinary empire.
Okay, I see how it gets messy.
And then you throw in dual-class shares. Those are like giving certain shareholders a secret ingredient that doubles their voting power.
Wow, so many players in this corporate kitchen. It's like banks, families, governments, institutional investors.
It really is a whole cast of characters.
Even the managers and board directors themselves can be influential shareholders.
Absolutely. Everyone's vying for a seat at the table.
How do we even begin to untangle all those motivations?
That's the million-dollar question, right? And it's where things get really interesting. Each player brings their own spices to the mix, their own motivations, and potential conflicts of interest. Understanding these dynamics is crucial.
Okay, so it's like knowing which flavors clash and which ones complement each other.
Exactly. For example, imagine a bank that has a major equity stake in a company. They might push that company to take on more debt.
Even if it's a bit too spicy for the other shareholders' taste.
Precisely. It's all about understanding the incentives at play.
Okay, so I'm starting to see how tricky this can get. How do we, as investors, avoid biting into a dish that's going to give us indigestion?
That's where strong corporate governance comes in.
Okay, good governance, got it.
It's like having a good food critic at the table to help you make informed choices.
Makes sense. Someone to guide us through the menu.
Exactly. Evaluating corporate governance goes way beyond just checking off a list of ingredients. It's about understanding the company's behavior, both in the market and how they treat all the stakeholders at the table.
So we need to understand their character, how they operate.
Precisely. Are they ethical? Are they transparent? Do they prioritize long-term value creation for all stakeholders?
Not just ticking boxes, but actually understanding how they operate and interact with the world around them. Where do we even start?
Well, you always want to check out the head chef, right? A good place to start is with the board of directors.
Makes sense. The ones calling the shots.
Exactly. They're the ultimate decision-making body. You want to look at their structure, their independence, and the role of key committees, like those in charge of auditing the books or deciding how much to pay the chef.
We need to see if they have the right recipe for success.
Exactly. And then you dive deeper, considering factors like their skills, experience, how long they've been there, and how diverse the team is.
It's like trying to get a sense of their overall effectiveness. Do they have the right mix of people and experience to make sound decisions?
Precisely. And you want to see that they're not just yes men to the head chef.
Right. We need independent thinkers.
A board with a high percentage of independent directors is generally a positive sign. It suggests there's less risk of management getting away with things that aren't in the best interest of all the diners.
Or in this case, the shareholders. So board structure and independence are definitely key ingredients in a good corporate governance recipe. What else should we be looking for?
Well, there's more to it than just who's sitting at the head of the table. Well, there's more to it than just who's sitting at the head of the table. You got to think about how those at the table are being compensated.
Wow, executive compensation.
Right. Bingo. How a company pays its top execs can be a big clue about their priorities.
Yeah, it's like, are they incentivized to just make more and more expensive dishes? Or is it about the overall quality and profitability of the whole restaurant?
That's a great analogy. You want to see transparency, performance-linked incentives, and most importantly, alignment with the company's overall strategy. And speaking of aligning interests, we can't overlook shareholder voting rights.
Oh, right. Different share structures can really skew things.
For sure. Some shareholders might have more voting power than others, which can heavily impact how the company is run. It's like some diners having multiple votes on the menu while others only get one.
Right, those dual-class shares we talked about earlier. It's all fascinating stuff. But I gotta admit, my head is starting to spin a little. How do we connect all these corporate governance considerations to actual ESG risks and opportunities?
That's where things get really interesting. Moving from the boardroom to the bigger picture now, remember, not all ESG factors are created equal.
Right. Some are more important than others.
Exactly. The ones that really matter are the ones that can significantly impact a company's operations, financial performance, and ultimately its valuation. Those are the dishes that can make or break the entire meal.
So we need to understand materiality. Which issues are truly important in the context of a specific company and its industry? It's like figuring out which ingredients are essential and which ones are just garnishes, right?
Exactly. Be wary of companies that try to dress up their plates with fancy garnishes but skimp on the main course. They might emphasize certain ESG initiatives that sound good on paper, but do they really move the needle financially?
So it's about seeing through the marketing fluff and really understanding what matters for long-term value creation, not just window dressing.
You got it. It's all about substance over style in the ESG world. And speaking of long-term thinking, we can't forget about the time horizon.
Yeah, a short-term investor might not care as much about a long-term environmental risk, for example.
You're absolutely right. Time horizon is another key ingredient in our ESG recipe. Think of it like this. A diner popping in for a quick lunch might not care if the restaurant sources its fish sustainably, but someone planning to be a regular patron would definitely consider the long-term impact of overfishing on the menu and the restaurant's reputation.
So a short-term investor might not worry about a company facing stricter environmental regulations in the future, but a long-term investor would absolutely consider the potential impact on profitability down the line.
Exactly. They'd want to know if that company's investing in sustainable practices or just kicking the can down the road. Now let's get practical. How do investors actually find this ESG data?
That's a great question. It can definitely feel like navigating a maze sometimes with all the different sources of information. It's not always easy to know what's reliable.
You're not wrong. The reporting can be inconsistent, and a lot of disclosures are voluntary. It's like trying to decipher a secret menu written in different languages. But there are resources out there to guide you.
Where do we even begin?
Start with the basics. Company reports regulatory filings, see if they have a dedicated sustainability report. Then explore specialized ESG data providers and industry initiatives.
Okay, so there are resources if you know where to look.
Exactly. There are also organizations like SSB and GRI that are working towards greater standardization, and frameworks like the Green Bond Principles are promoting transparency in sustainable finance.
So it's about knowing where to look and being discerning about the information you find. It's like being a savvy diner who knows how to read between the lines of the menu and ask the right questions.
Exactly. Now let's bring all of this to life with some real-world examples. Remember that beverage company we talked about earlier? We said water intensity was a key metric to watch for them. Well, let's say their water intensity ratio has been steadily declining over the years, meaning they're using less water per liter of beverage produced.
Okay, that's sounds like a positive sign. They're becoming more efficient with their water usage.
It's a good start, but we don't stop there.
Yeah.
We need to compare them to their peers. How are they doing relative to other companies in the industry? Are they leading the pack or lagging behind? It's like comparing their water usage to the industry average. Are they using significantly less water per liter of beverage than their competitors?
Right, because even if they're improved, if everyone else in the industry is doing even better, it might not be enough to give them a competitive advantage.
Exactly. Now, let's say our company's water intensity has decreased significantly more than its peers over the past few years. This suggests they're taking water management seriously and could even have a competitive advantage as water scarcity becomes a bigger issue.
So they might be able to keep their costs down even as water becomes scarcer and potentially more expensive. They've essentially future-proofed their business in a way.
Now, to really integrate this information into our financial analysis, we might adjust the company's operating costs to reflect this improved water efficiency. We could lower their projected cost of goods sold, leading to higher forecasted earnings and potentially a higher valuation. It's like realizing they're getting a discount on a key ingredient, which makes their dishes more profitable.
So their commitment to sustainability is actually translating into tangible financial benefits. It's not just a feel-good story, it's impacting their bottom line.
Precisely. And this same approach can be applied to social factors. Remember that pharmaceutical company grappling with product quality issues? We need to quantify the impact of those controversies.
Things like lost sales, lawsuits, regulatory fines. How do we factor those into our analysis? It's like figuring out how much those negative reviews are costing the restaurant in lost revenue.
Exactly. We might adjust their projected revenues downward to reflect the potential for continued lost sales. We could also increase their operating expenses to account for things like product recalls and legal costs. These adjustments would paint a more accurate picture of their financial health considering those social risks.
And this could ultimately lead to a lower valuation, reflecting the increased risk associated with their product quality track record. It's like a discount applied to their stock price because of the uncertainty and potential future costs related to those controversies.
You got it. Now let's shift gears to governance and that bank holding company example. We talked about scrutinizing their board composition and risk management practices. Let's say they also have a very limited say-on-pay policy, meaning shareholders have little influence over executive compensation. It's like the diners having no say in how much the chef gets paid, even if the food is consistently mediocre.
That sounds like a red flag. It suggests a lack of transparency and accountability.
Right. It might indicate that executives are being rewarded even if the company isn't performing well and their compensation isn't aligned with shareholder interests. This lack of shareholder oversight could increase the risk of poor decision-making and ultimately harm the company's long-term value.
So in that case, we might adjust their cost of capital upward to reflect this governance risk, which would lower their valuation. It's like factoring in a risk premium because of the potential for mismanagement and value destruction.
Exactly. And when it comes to bond valuations, we'd likely see this reflected in a wider credit spread. Investors would demand a higher return for lending money to a company with weaker governance practices.
These examples are incredibly helpful. They really demonstrate how ESG factors can be woven into traditional financial analysis. It's not about throwing out the old playbook, but rather enhancing it with a deeper understanding of a company's ESG performance and how it might impact their financials and valuation.
That's the key takeaway here. ESG integration isn't about reinventing the wheel. It's about looking at the wheel from all angles, considering its sustainability, its impact on society, and the governance that guides its direction. It's about having a more holistic view of a company's performance and potential.
It's like upgrading from a basic bicycle to a high-performance mountain bike with all the bells and whistles. You're still riding a bike, but you're equipped to handle a much wider range of terrains and challenges.
Exactly. And remember, ESG factors can be both risks and opportunities. By carefully analyzing a company's ESG performance, we can identify potential red flags, but we can also uncover hidden gems, companies that are well positioned to thrive in a world that's increasingly focused on sustainability and responsible business practices.
It's about finding those companies that are not just serving up a delicious meal today, but also cultivating a sustainable and ethical food system for the future. They're investing in their ingredients, treating their staff fairly, and ensuring they'll be around for years to come.
I couldn't have said it better myself. Now I'm curious, what's resonating with you the most from our discussion so far? What's standing out as particularly important or surprising?
You know what's really clicking for me is how ESG analysis adds a whole new layer to understanding a company's potential.
It's like we were looking at a flat picture before, and now we've got those 3D glasses on.
Exactly. Now that we're seeing the full picture, how do we actually build a portfolio that reflects these ESG values? And it hopefully enhances our returns too.
That's the goal, right? To make smart, informed decisions that align with our values.
So how do we put all this ESG knowledge into practice?
Well, there isn't just one right way to do it. It really depends on what your goals are and what's important to you. But let's explore some common approaches.
Okay, sounds good.
One that's been around for a while is negative screening. It's like being a picky eater.
Oh, I like this analogy.
You exclude certain companies or industries from your portfolio based on specific ESG criteria.
So if you're worried about climate change, you might avoid investing in fossil fuel companies.
Exactly. Or if you're passionate about animal welfare, you might steer clear of companies involved in factory farming.
It's about putting your money where your mouth is right.
Precisely. You're saying, I don't want my money supporting activities that I find ethically or environmentally problematic.
It's like voting with your dollars. Okay, so that's negative screening. What else is out there?
Well, on the flip side, you have positive screening. This is where you actively seek out companies that are leading the charge in ESG performance.
So it's not just avoiding the bad, it's actively seeking out the good.
Exactly. You're putting your money behind companies that are trying to make a positive impact.
I'm liking this approach.
Yeah.
But what about all this ESG integration we've been talking about? How does that play into portfolio construction?
ESG integration is really about weaving those considerations into every step of your investment process.
So whether a company is an ESG leader or a laggard, we're still looking at those factors and how they might impact its financial performance.
Precisely. It's not just about excluding companies. It's about having a more holistic view.
So it's like reading a restaurant review that talks about the food, but also the ambiance, the service, and if they source local ingredients, you get a much richer understanding.
Exactly. And the great thing is you can use these approaches individually or combine them to build a portfolio that really reflects what's important to you.
No one-size-fits-all solution, which is great. But let's be real for a second. At the end of the day, we want our investments to do good, but also to do well. Is there evidence that companies with strong ESG performance actually have better financial returns?
That's the million-dollar question, isn't it? And the research is still ongoing, but there's a growing body of evidence suggesting that companies with strong ESG performance might actually be better positioned for long-term success.
Makes sense. They might be managing risks better, attracting top talent, or appealing to consumers who want sustainable and ethical products.
Exactly. All of which can contribute to a stronger bottom line and potentially higher returns for investors.
So ESG investing isn't just a feel-good niche strategy anymore.
Not at all. It's becoming more and more mainstream as investors recognize the potential financial benefits.
And as more investors demand ESG information, companies are being held to higher standards,
Absolutely. It's a win-win situation, really.
driving progress towards a more sustainable future. This has been a fantastic deep dive. We covered a lot of ground, from corporate ownership to ESG integration and building ESG-focused portfolios.
We really went deep. And remember, the journey doesn't end here.
There's always more to learn in the world of ESG investing.
Exactly. But by taking the time to understand these concepts, you can become a more informed, impactful, and successful investor.
Couldn't have said it better myself. Thanks for joining us for this deep dive into the world of ESG. Until next time, keep exploring, keep learning, and keep diving deeper.